All right, welcome back to another edition of Financial Accounting. Thank you, ladies and gentlemen, for joining me today on this cold afternoon. Hope you're staying warm over there. A couple things that we want to talk about first, in particular, the schedules. So today we're going to talk about 4.4 and 4.5. We should be able to get through all of that today. Just realize that the homework 4.4 and 4.5 is due tomorrow. 4.4 will take you some time. That bank reconciliation tends to be a little bit tricky for some people when they go through that. On Wednesday, we'll go through a review to help us prepare for exam 2, which will happen during normally scheduled class time this Friday. So make sure you have that time booked accordingly. You need to make sure that Proctorio is installed on your computer. Same process as we did before. I've put up on Blackboard in the exam 2 information folder the review notes, which we'll go through on Wednesday, as well as a couple practice exams, one with, one without Proctorio. Make sure you check that out. Um, we'll go into more details about that. You probably will see practice questions for exam 2 on my accounting lab that you're free to do that. Those are unlimited in attempts. So by all means, check those out, see if those help prepare you. You don't have to do any of the practice material, but I strongly encourage you to do it for this upcoming exam because the material is very challenging. So let's not delay. Let's jump into 4.4, the bank reconciliation. This tends to be a really sticky part for a lot of students in this class because a lot of the concepts in here are fairly new and somewhat difficult to grasp conceptually. So the issue we have when we're doing any type of adjusting journal entries at the end of the period is looking at our cash T account and figuring out whether or not that balance is up to date and accurate. And usually it's not equal to what we see on the bank statement. So if we're looking at a 12/31, a December 31st balance on the bank statement, and we try to compare it to our December 31st balance in our cash account, T account, oftentimes they won't equal each other. And that's nothing to fret about. Usually the reason why you see a difference is because of some type of timing lag of when information is exchanged. So as an example, assume that we cut a check, we issue a check, we write a check, we put it in the mailbox, and we send it off to our utility company. The bank is not aware the moment we write a check when we've actually submitted that check, when that check's actually been received. The process starts with us writing the check, putting it in the mail, having it go all the way to, say, the utility company, waiting for them to process the check, then depositing that check at their bank, having their bank update their checking account, and having their bank transmit the check over to our bank by mail. And that takes a long time. So in between, there's this timing is information that we have recorded in our T account that the bank is not yet aware of and therefore hasn't recorded on their side. So that is one example, one key example as to why we see a difference between our T account for cash and what the bank is saying is our balance. It all has to do with this timing lag. So we'll go through some examples of how this happens on both ends. How do we keep track of these differences? So we use what's called the bank reconciliation, where we are going to account for all the differences between book, which is our T account, book side, books, ledgers, right? Our T account for cash is the book, and the bank side, the bank statement, what the bank is saying is our cash or available cash balance. Typically, we need to reconcile both the book and the bank balances. It's not just that we have done things the bank doesn't know about. It's also that the bank has done things that we don't know about. So we're going to reconcile both sides. And this is kind of how it looks. And so you might see this side by side, or you might see it vertically in your homework. But generally speaking, when you see the bank side, generally what you do is you start with whatever the bank is saying is the December 31st balance per their records. And then you ask yourself, what does the bank not know about? What does that account balance not include that we have recorded in our T account? Those adjustments get recorded. Those adjustments get put on the bank side to determine what's called a adjusted bank balance. But that's not the only thing we do. We also have to look at our T account for cash. Cash T account, that balance, whatever that is, that's what we start with on the book side. Then we ask ourselves, what has the bank done that we don't know about and haven't recorded? Those adjustments get shown on the book side to determine an adjusted book balance. So in this case, realize we don't really know what the true amount of cash is until we fill out the bank reconciliation. And remember, this is just a matter of a timing difference. We become aware of things after the fact. We need to make adjusting journal entries. The bank will take its sweet time updating its information as the information is received. So this is just for our personal records. So here's how I recommend you start processing this stuff. First, you want to look at the bank side. Given the statement, ask, our cash balance may include effects of payments and collections that the bank is not yet aware of. So what are some things that we've recorded that do not appear on the bank statement? Maybe we've cut a check. Maybe we mailed a check. Maybe we received cash and updated our T account, but the bank hasn't received that check yet. Well, there's a lot of things that we have done on our side. So we need to ask ourselves, what information do we need to include on the bank side to adjust the bank's information to what really represents as adjusted bank balance? So we adjust the bank balance to reflect the payments and collections that we have recorded that the bank has not yet been informed of. We put that on underneath the bank balance, and then we calculate an adjusted bank balance. That's what this is, an adjusted bank balance. Now, given that we've done this, don't expect to go to the bank with this information and say, hey, you guys need to update my bank balance. It's too out of whack for whatever reason. They're just not going to care. This is for our own purposes. We need to know why the bank balance is maybe too high or too low relative to what we think it should be. The caution you have to worry about is that when you come up with an adjusted bank balance, realize that it will not likely equal our T account balance. And the reason why this will not equal our T account balance is because there are things the bank has done that we haven't recorded yet. So granted, there's like information is being slowly transmitted from left to right and from right to left. So we're going to do both sides here. We've looked at the bank. We said, hey, bank, you haven't recorded these items that we have recorded. Now we're going to say, let's look at the bank statement and ask ourselves, what has the bank done that we're not aware of? The bank's balance may include effects of payments and collections that we are not yet aware of. And we can be aware of that if we go online every minute of every day and look at our checking account, but that's too tedious. We usually just wait till the end of the month to get the bank statement. And then we look to see, hey, what's the bank done that we don't know about or didn't know about? If there are things the bank has done that we haven't recorded, we need to adjust our T account, our book balance, for those payments and collections the bank has already recorded. The bank recorded it. We haven't yet because we didn't know about it until just now. So that's what's going on the right-hand side. We're looking at what our T account says. We're saying now we need to include the effects of any bank collections and bank payments. When we do that, we come up with, I should say book side, my bad on that one. We come up with what's called an adjusted book balance. So we have on the left side an adjusted bank balance. That's what we see there. Again, that should say book, right? We have an adjusted bank balance on this side, an adjusted book balance on this side. These two balances, they must equal. They will equal if we've done it right, but they most definitely must equal each other. So just realize that what we're going to go through next is look at what the bank doesn't know about and what we don't know about. And we're going to make adjustments to those balances to come up with an actual cash balance here. So starting with the bank side, is there like a checklist of things we should run through to see what we've done that the bank doesn't know about? Because that's what we're starting with, what the bank does know and has done. These adjustments are what the bank doesn't know about and therefore has not recorded. So what do we, the company, know that the bank does not yet know? Well, there are really only three things. Okay. And this is why I encourage you guys to start by learning the left-hand side, the bank side, because you only have to really remember these three things. Everything else is going to be on the right-hand side. D for deposits in transit, O for outstanding checks, and B for bank errors. This is DOB. Deposits in transit. We may have collected cash from customers and therefore have increased our cash T account for those collections. We may have even gone to the bank and made those deposits on that particular day. But the bank may take 24 to 48 hours to actually process those deposits. So in that case, we call them deposits in transit because, yes, we've recorded them, but that information is still in transit to the bank. Our bank balance has not been updated because our bank just simply hasn't had enough time to process that information. Therefore, our bank balance is going to be too low. Why is it too low? Because they're not showing deposits. Those deposits are going to eventually increase the bank's cash balance. So in the meantime, on our bank reconciliation, we're going to say, hey, it's cool, bank, you have your own information. We'll start there, but we're going to we're going to show on this bank reconciliation this adjustment upward for these deposits that you haven't quite yet updated in your system. We're going to make a little adjustment, make a little mark on our bank reconciliation to reflect that. Likewise, if there are checks, kind of like going back to the first example at the start of this, when we've written a check, realize it's going to take maybe a week or longer for the bank to actually update its records. So if there's any checks that haven't been processed by the bank yet, yes, we'll show that credit on our T account, that reduction to our cash account, but the bank hasn't reduced our cash account yet because they haven't received that information. Therefore, the bank balance is too high, and we need to show a line item that reduces it down for any outstanding checks the bank hasn't processed yet. Finally, there's bank errors. You don't see them too much. Sometimes they give us too much, sometimes they give us too little. Trust that the bank is going to figure that out and fix it, but it may be about a month before that even happens. In the meantime, we may need to make an adjustment up or down for any type of temporary bank error. Overall, you get DOB, deposits in transit, outstanding checks, bank errors. When you think DOB, you think date of birth, right? DOB, deposits in transit, outstanding checks, and bank errors. If you can remember that, just for the sake of the upcoming exam, you'll be all right because all those adjustments we just made there on that side, you'll get information about all the right-hand side adjustments. That's all the other stuff that's not DOB. So as an example, on the left-hand side, we're adjusting bank to the adjusted or the actual. Assume that we're given information about the bank statement balance. This is what they say we have at the end of the year or the end of the month. Telling us we have 5,900. Okay. What do we know and have recorded that the bank does not know and has not recorded? Right? Let's compare the bank statement with our T account to see payments we made that the bank doesn't know about. Let's look at deposits that we've recorded that the bank doesn't know about yet. Deposits in transit, assume it's 1,600. That's en route. The bank will update it eventually. For right now, the bank balance is too low. We need to up it by 1,600. There's some outstanding checks that we've written. This could be a situation where the people we wrote the checks to just haven't gone to their bank yet. So if we look at the bank statement, we can see an order of checks that have cleared. And if we don't see certain checks that we've written based on the check stubs in our checkbook, if we see that some checks have not cleared yet, we call those outstanding checks. In other words, we wrote checks 337, 338, and so on. Those may have happened perhaps even today as of the end of the month. But not enough time has gone by to where the bank has updated its system. So all these check amounts, when we add them up, represent outstanding checks. These represent a need to decrease an adjustment to decrease the bank balance because the bank hasn't decreased it yet on their side, just because of a timing difference. Assume in this case that there's a bank error where they erroneously decreased our account by $100. You don't see it too often. Realize if the bank does make an error, they're going to figure it out pretty quickly. And even if we have to make a temporary adjustment now on the bank rec, we won't need to make it probably in the next month going forward. How do we fill in this information on the bank reconciliation side? Number one thing is we want to start with what the bank says our balance is at the end of the month. Then we start going through and making adjustments. The first adjustments we want to make are additions. So we're going to add any deposits in transit, 1,600. And then in this case, we need to reverse out the correction. We need to reverse out the error. So we're going to correct the bank error. Bank erroneously decreased our account. They'll fix it soon enough. But right now we need to bump that balance up because it shouldn't read 5,900. It should at least read 6,000. They made an error. Then we go through the less. We subtract. Well, actually, some of your homework problems might ask you to put in a subtotal here. Go ahead and do that. Then go down into the outstanding checks and just itemize off what the checks are and how much we wrote the checks for. We sum up all those. Make sure you may have to put in a negative amount for all of those outstanding checks or put in parentheses to reflect it's a subtraction. When you subtract the 7,600 from the 1340 from the 7,600, you get 6,260. That represents the bank's adjusted balance. And again, don't expect to go to the bank and say, hey, you need to update my account for this stuff. They're going to look at you and say, get out of here. Right? This is just for our records. That's a good starting point. Now we have a check figure we can use to help us figure out the right-hand side. Again, if we did DOB on the left, we're going to do any type of other information on the right-hand side. Look at the book. We're going to adjust book to an adjusted balance. Here, we have a T account balance of this amount. We need to ask ourselves, what does the bank know and is recorded that we, the company, do not yet know or have not yet recorded? Okay. Is it possible? Yeah, there's a lot of things a bank can do that we don't know about until the very end of the month. So let's look at these things. There's quite a few of them. There's like 7 of them here. Okay. Bank collections. Sometimes the bank makes collections on our behalf. So we may have an arrangement where we have somebody submit a check. Maybe we have a little drop box or something that customers can put checks in at the bank. The bank collects it for us. That's one less trip we have to make at the bank. Fine. If the bank collects money for us, the bank is going to automatically increase our checking account. That means our balance, if we don't know about it, our balance is going to be too low. Therefore, we need to make an adjustment upwards to reflect the fact that the bank has collected money for us, and therefore our T account needs to go up. Banks sometimes offer interest on their checking accounts and well, at least on their savings account, not so much on their checking accounts. When banks offer us interest on those accounts, they'll usually just automatically deposit that interest into our accounts. So in that case, the bank will increase our account. And if we don't know about it, that means our T account balance is too low. We're going to need to make an adjustment upwards for that. Book errors. If there's going to be any type of errors, usually you're going to see it on the cash side, on the book side. So here's a situation where maybe we accidentally increased or decreased our cash account. Usually that requires us to make some sort of adjustment in the opposite direction to fix those things. Bank balance is going to be fine. The book errors are strictly our business. We have to fix that. This is a big one that happens often to us. Service fees. Banks love to charge fees, and when they do, they automatically take it out of our accounts, and we don't find out about it until, guess what, the end of the month. So when we find out about it, we're going to be like, oh, damn it, here's another fee that they took out of my account. Bank took the money out. We need to reduce our account. Keep in mind that all these adjustments we're noting on the book side, we're going to have to make journal entries for these. But for right now, let's just go through all the different types of adjustments we need to make here. 3 more here. Non-sufficient funds. This is a situation where someone wrote us a bad check, okay, or the check bounced. We trusted when we got the check, we went ahead and debited cash, trusting that it was a good check, and we went ahead and credited the customer's accounts receivable. That's fine. Later, we find out now it's a bad check, and the bank's not going to honor that. So we're going to have to make an adjustment, reverse out that journal entry later on here. But for right now, an NSF check is a reason why we would potentially have to reduce our T account downwards. EFTs, believe it or not, you guys do this on a regular basis. If you work for a company that automatically will direct deposit your paycheck into your checking account, that means that your bank account will increase when your employer directly deposits your paycheck. You may not know about it, so your own personal records will show a cash balance too low. You'll need to make an adjustment upwards for those direct deposits. Likewise, if you're like me and you have a Netflix account, by the way, they just raised rates on Netflix again. Jesus. Anyways, if you have an account with Netflix and you're like me, you probably have the Netflix fee automatically withdrawn from your checking account, so you don't have to write a check. That kind of auto withdrawal automatically reduces your checking account at the bank. You may not know about it until later, so you're going to have to make an adjustment downwards. Checks are pretty expensive. But whenever you make a request to have new checks printed and sent to you, oftentimes the cost of that will automatically be taken out of your checking account. And if that's the case, that means you also need to make a reduction on your side. If you forgot to do it, you need to make a reduction in your T account. Again, these are just a checklist of things. Is it possible we actually do find out about these things when they happen? Of course, but oftentimes we just prefer to wait until the end of the month to collect all that information. So, how do you sort of remember all these different things on the book side? Well, bank reconciliations, bank collections, interest, book errors, service fees, NSF, EFTs, cost of checks. That's bibs. And bibs go around what? The neck. So, this is not my kid, by the way. This kid's way too cute. If you think about a bib, right, this is the bib. Bibs go around what? Bibs go around the neck. Granted, it's NECK, right? But you get the idea. If it helps you remember like what goes on the right side, think bib's neck. If you think about the left side, just remember date of birth, DOB. Practicing this over and over again is key, of course. Always get to practice accounting in order to really get it. So let's look at an example of reconciliation on the right-hand side, the book side. Assume that our T account for cash, this is cash. Let's go ahead and assume that there's a balance. We've had some debits, we've had some credits. We have 3340. Let's assume that that's our balance in our ledger or the books. So if that's the starting point right there, what is the information given to us? What's the bib's neck that we need to adjust for? So maybe the bank made a collection we weren't aware of for 2100. That's fine. We just need to increase our cash account for that. Now that we know that, we need to debit cash eventually. We'll get to that in a second. Maybe the bank automatically deposited interest into our account. Thanks, bank. I appreciate that. We'll have to record that. This book errors tend to be a little bit of a tricky part. So bear with me here. You got to read these kind of carefully. Assume that the company erroneously recorded a check payment. So the actual amount that was paid was $150. That's actually what the bank, that's actually what the bank honored, $150 decrease, okay? But when we look back in our T account and we look back at that check, we see that we didn't credit cash for $150. Let's assume that in this case, we actually recorded a credit of $510. It seems reasonable to say, oops, we screwed that up. We should just go ahead and erase it and plug in 150, okay? We don't do that in accounting. If we mess up, we leave it in there. Yes, it's an error. Then we just figure out what do we need to record to offset the portion that's wrong, okay? 510 was what we credited. It should have been 150. So how do I go from how do I decrease this down to 150? I'm going to record a debit of 360. It seems a little weird, right? But when you look at the net of these, a debit of 360 and a credit of to offset a credit of 510, what's the net effect of those two entries? It's 150. That's the correct amount that should have been credited. So the 360 that we're recording here, it's not representing cash received. It's just representing the amount of this 510 credit that was wrong, that was an error. Given that's the case, we would do a debit of 360, which looks like an increase to our cash account. Service fee of $20. Thanks a lot, bank. We have to record that decrease. What do we do? Oh, we're not quite done yet. There's still more. We have a bad check. We have a deadbeat customer wrote us $50 check. Now, in this case, that means our T account is too high and we need to reduce it. So think about it like this. In the cash account, we had recorded a $50 debit, right? We come to find out that that's a bad check. We're not going to, the bank doesn't give us that cash. So we're going to have to do an offsetting credit to get rid of that. And then we go back to the customer and say, give us the money, make sure it's good this time, give us a cashier's check. EFT payments. Let's say we got our broker automatically deposit dividend revenue from our investments account. That was auto deposited. So that would be an increase, an EFT increase. And let's assume, I think in this case I said utilities, but it could be utilities or insurance. I have my insurance company automatically pull cash out of my checking account. I have my utilities company do the same thing. You can set up a lot of your regular cash payments to these on a monthly basis with all these different vendors. In this case, I assume it was $400 utilities expense. It was automatically pulled out of our bank account. We're going to have to decrease our cash account for that. In this situation, assume that we didn't buy any new checks, but it's just part of the checklist. Did we buy any new checks that we haven't recorded yet? Given that's the case, how do we fill in the right side of the bank reconciliation? Okay, start with what the T account says. Our ledger account says that we have a debit balance of $3,340. We need to go through and start with the additions first. This is what I recommend. We got to go through and plug in the dividend revenue of $900. The bank collection from the note receivable, $2,100, interest revenue on the bank account, and then the correction of an error. This is not cash received. We're just fixing an error. Okay, we're counterbalancing an error on the credit side with this debit of 360. Then go through, well, come up with a subtotal. Your homework will probably ask you to do that. Then go through and do all the deductions. We need to account for the service fee, the bad check that the customer wrote us. We have to account for any type of automatic payments to Netflix, our insurance company, our utilities company, whatever. And then we record the total as a negative number. Do our math on the way down, and then boom, gives us an adjusted book balance. Now, at this point, when you do this for the homework, you'll automatically compare this number with the adjusted bank balance. And oftentimes you'll find they two don't equal each other. So down below, sorry, was that Mike? Was it 400 or 470? What's the deal here? This 470 is the sum of these guys right here. That's what I'm getting there. You see that, Mike? The sum of all of our subtractions is that 470. Got it? Cool. So remember, sometimes we indent to the left. No, you're not done. Sometimes they do this. Sometimes you don't. So if they do it like an indent column to the left, they're just trying to like itemize things just to keep things cleaned up. Sometimes you see it, sometimes you don't. So anyways, and also too is like you don't see, this is the thing this is what's dumb about the example, is that if they don't put parentheses around these guys. So that's kind of confusing, right? So just realize, like, just be careful when you're reading through things. See where they're trying to go with this. It's a subtraction in this case. They're just not very good at showing it in this example. Now, you get down to it, you compare your bank side with your book side, and we see, lo and behold, our adjusted bank equals our adjusted book. right? That must happen. If it doesn't, we need to go back and figure out what's wrong. If you find that your adjusted bank doesn't equal your adjusted book, go back, check DOB, check BIBS, NEC. Okay, make sure the items show up in the correct left side or right side. If you got the things in the right place, left side or right side, check to see maybe you're adding instead of subtracting or vice versa. That's usually the case. Sometimes you can subtract these balances and figure out what the difference is. Usually that kind of helps you out figuring out where the mistake is. But that's the goal, and that's a pain in the butt. By doing that over and over again, hopefully you'll get the routine of like identifying things, because I'm always asking you guys questions about what should show up on the left side, what should show up on the right side. How would you determine what is the adjusted bank balance, right? There's always an exam question about that stuff. So we're not done yet, though. As if that wasn't a pain in the butt enough, we now need to go through and do adjusting journal entries for the adjustments to the book side. So everything on the right side that we just went through, we now need to record these in our journal and post it to the T account, the ledger account for cash. So I recommend starting with the additions, the debits to cash. Debits make me happy. So we have the EFT receipt, we have the bank collection, interest, we get the correction here. When you go into the journal, just realize for everything we got, we're going to debit cash, debit cash, debit cash, debit cash. Okay. When you do that, I recommend starting with that. Start filling out the journal with the debits for the things you have to add to cash, the cash account. The offsetting accounts, sometimes the selection is rather intuitive. If it says we got dividend revenue, use the dividend revenue account for the offsetting credit. Collection of account receivable, well, that just means that accounts receivable will decrease with a credit. Interest revenue means we're going to have credit to interest revenue. Notice how revenues are always credited, except when you close it out. So revenues are always going to be a credit. There's a correction of a book error. In this case, let's see, let's go down to the bottom here. Assume that what we paid off, we had over debited accounts payable. We need to adjust that backwards. So we're essentially kind of reversing out the over crediting of cash by doing this adjustment here. Just plug that sucker in there. It'll take some time to kind of get used to this, but it's really the errors I think that throw people off the most. So if you have questions about that, just click the Ask My Professor to help me solve this. I can walk you through it. It takes time. Be patient with yourself. Then go through and do the items that you're subtracting. Here we're subtracting these service fees. We got to subtract out the bad check. We got to subtract out the auto withdrawal. So in this case, start filling it in. These are all reductions. Just go through and do credit cash, credit cash. Credits make me unhappy, right? There goes all my cash. Plug those in and then go back and figure out what's the debit, what's the account that I need to debit. In the case, well, I think I said utilities, but insurance expense, utilities expense, whatever that $400 was for, just call that the expense. NSF return check to a bank. This is one where we essentially are putting back into accounts receivable $50 because a customer gave us $50. We thought it was good, so we went ahead and credited accounts receivable thinking it was good. And we find out that they're deadbeats, so we're putting it back into accounts receivable, and now we go hunt them down. And when we collect it, when we actually get a good check from them, that's when we'll go ahead and credit the receivable to get rid of it. So we're kind of like reversing out. This is like a reversal entry of what we did, say, during the month or during last month. Miscellaneous is the account we use for different small amounts. So if you're looking for some type of an expense account for service fees, just look for like a miscellaneous. Anything that's a small amount usually will go to like a miscellaneous. Your problems usually tell you which activities go to the miscellaneous expense account. But boom, once you get that done, then the T account should be all up to date. So where did we go? We had the cash account, right? It was like 3340, right? And then we had to debit a few things. We had to credit. These are all the adjusting. These are all the AJEs we just did, right? And these are all the things we just did up above. When we did that, realize that just another thing you want to check is, oh, go away. When we go through and we post all the effects of those journal entries to the cash account, we should see 6260. Remember, that's the adjusted cash balance that we, per the bank reconciliation, that's the adjusted bank balance, adjusted book balance. That's what we should see after we've done all of our adjusting journal entries. Cash should be up to date now, given that we've now recorded all the things the bank did that we did not know until just now. I want to jump into 4.5. There's only a few slides there, then I'll open it up for questions here. But 4.5, this is kind of just a concept that sort of throws people off a little bit in terms of the math. When we think about cash, we think about cash in a savings account, cash in a checking account. But there's also this thing called a cash equivalent. Why do we call it a cash equivalent? Well, it's kind of like cash. It's really close to cash. It's practically cash. What it is, and the cash equivalent is, it is an investment. It's not an investment in stocks and bonds, okay? It's an investment into a very short-term, in and out kind of investment. Maturities of 3 months or less from the date of purchase. Typically, these things are like what we consider time deposits. If you go to a bank and you say, hey, are there any time deposits I can invest in? Usually they offer what's called a certificate of deposit, a CD. They say, well, we notice that you have $1,000. Usually your cash balance doesn't go below $2,000. So they may offer you, say, take $500 of your cash balance and put it into a 3-month CD. You get a very little bit amount of interest, but it's something, sometimes better than nothing. So this whole purpose of a short-term investment is to take money that you're not using and actually make a little bit of cash on it. And it's very low risk because you're going to get the cash back very quickly. So it's a 3-month investment. You invest in it, and then you go 1, 2, 3 months, and then you get cash out. Okay. That's your investment. It's 3 months in and out. It's so close to being to its maturity date that's practically considered cash. Anything that goes beyond 3 months is just a regular investment. So it's kind of a tricky thing, but not really. You just want to ask yourself, is this investment, if it's a CD or some type of government security, whatever, if this has a maturity in less than 3 months, that means I'm required to cash out from the investment within a certain period of time. At maturity, I get my cash back. When does that happen? From the time I get into it to the time I get out. Is it 3 months or less? If it's yes, it's a cash equivalent. If I have to be locked into an investment for more than 3 months, it's just a regular investment account. Okay. That's the distinguishing feature about 4.5. Not a lot of tricky questions about that one. So I just want to make sure with some examples here that you understand what I'm talking about when I say this certificate of deposit, this cash equivalent. My recommendation is when you come across a cash equivalent question, draw out a timeline. If you don't like drawing, that's fine. Or you don't trust your drawing skills, then just add the total investment period. Okay. If I purchased a CD 1 month ago, meaning I put cash into a CD investment a month ago, then on the timeline, I'm right here. A month ago, I got into this investment. It matures in 2 months, meaning that I'll get my cash out of this. The maturity period means the investment is done. It's over with. Cha-ching, here's your money back. That matures in 2 months from now. Sum up the total amount of time that the cash has been locked up. In this case, it's been 3 months. So if that's 3 months or less, it's a cash equivalent. If it's 1 month, cash equivalent. 2 months, just round to the nearest month. We're not going to do days in this class. Okay, so just round to the nearest month. 1 month ago, 2 months more to go, 3 months total, that's a cash equivalent. That's all you need to know. Okay. Purchased the CD 3 months ago, matures tomorrow, round to the nearest month. 3 months ago, 0 months left to go, 3 months total. Draw it out on a timeline. You see, the saying is only a 3-month lock-in period. It's a cash equivalent. Okay. Don't try to force this issue. If I give you examples where all these things are more than 3 months, then just consider them not cash equivalents. If I give you nothing but 3 months or 2 months or 1 month investments, just consider them all cash equivalents. Don't overthink this. Purchase CD 3 months ago, matures in 3 more months. What's the lock-up period? How long do I have to keep my money tied up? Well, it's 3 months previous, 3 months more to go. So if it's 6 months total, it's an investment. It's not a cash equivalent. It's going to take me some time to get that money back. Purchased it 3 months ago, matures in 6 months. 3 plus 6, 9 months. That's an investment. Purchase a CD 6 months ago, matures tomorrow. If it says purchase it 6 months ago, automatically you know I've been locked into this thing for more than 3 months. Okay. 6 months total, or 6 plus 0. It's an investment. 6 months ago, 3 months left to go. 9 months. Purchase a CD 1 month ago. Okay, interesting. If I go another month or 2, I'm good as a cash equivalent. This is saying now you got to wait another 8 months. Well, that sucks, right? 9 months total. 1 plus 8. That's 9 months my money is locked into this investment. Draw it out if you're not sure. 1 month ago, 8 months later, that's a total of 9 months, right? That's the investment. It's not a cash equivalent. So what are cash equivalents? They're essentially things that are going to be turned into cash within 3 months. So that's why the FASB says, then call these investments just a cash equivalent. They're never really meant to be locked in for more than 3 months at a time. You do that, you should be fine for the exam. Never hesitate to draw things out. Journal entries, T accounts, I'm telling you, like a lot of these homework problems I've given you, you got to draw out these balances. They tell you a beginning balance and ending balance, and they tell you this is how it changed. Draw it out in a T account. Do the algebra. Figure out what the plug figure is. What's your X value? It saves me so much frustration if I just take the time to draw it out. So those are all the notes I have for Chapter 4. That's all you need to know for the exam from Chapter 4, just 4.4 and 4.5. I recommend jumping into the homework for 4.4 right now, because the bank reconciliation, it takes some time to practice it, to get the rhythm of it so you get it down. Don't put that off to the last minute. It's a tricky topic for most people. Okay. But I have office hours tomorrow, so you're welcome to send me any requests for help in the meantime through email. But I'll open it up now for any questions that you guys have.